Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. We've got Scott with us today from Sow and Reap Capital. So thanks, Scott. Thanks for joining us. Appreciate it. And what we're going to talk about today is, I'm going to say, the inverted yield curve and recessions and deleveraging in the economy and stuff like that. I've been mulling over. Well, I'll just put it this way. All right. We've got this process, and this is kind of what everyone looks at. They'll say the first process is like a recovery phase. We go into an expansion phase. We go into some hypersupply phase, and then we go into a recession. That's the cycle that the real estate market goes in. They consider that to be the business cycle. The real estate cycle is the business cycle, is how most people would put it. And that is the cycle. And when we look at this cycle, we go from like very low inflation, low interest rates to increasing inflation, higher interest rates. And that's when the yield curve inverts. The short end of the interest rates go higher than the long end. That's called an inverted yield curve. And then the next thing after the yield curve inverts is it uninverts, and then we get a recession. And one thing that's very different this cycle is we've got the stimulus money that they pumped into the system. What, in my opinion, what causes the curve to invert is inflation. But this inflation isn't caused by the real estate market. It's not caused by the business cycle. It's caused by stimulus money that they pumped from the medical event in 2020. I mean, they pumped the living poop out of this thing. So the question is, did the stimulus money speed up the business cycle? Or are we getting a double hump where we've got like two business cycles where the interest rates went to an unsustainable level for the housing market. The housing market cools off a little bit because the stimulus money and inflation pushed it that high. And now it's got to come back to a level where the real estate market kicks back on. What's your opinions around this, Scott? I mean, I've been mulling it over myself. I don't hear anyone else on YouTube or anywhere else really talk about it. What's your opinions there? Do you think the stimulus money is the cause of the inverted yield curve? And do you think it's speeding up the business cycle? How do you think this is all going to play out? I mean, it's a complicated topic. We haven't seen it in history, so it's kind of, I'm just throwing it up in the air and seeing what opinions stick.
Yeah, I don't really have any thoughts on whether it's speeding up the business cycle, because I think we just, for me, I would just want to wait and see what happens from here onwards. So, some of the key metrics I'm looking at is delinquency rate, for example. So I think it's first important to understand what happens when the yield curve inverts. Oh, can you let me share my screen, please, Andy?
Oh, yeah. Go.
So what happens? All right, let me just take this off. So okay. So basically what I've got here is we've got the US 2-year yield and US 10-year yield. So basically, traditionally what happens during a normal business cycle is the gap between the short-term bonds and the long-term bonds is usually how the banks make money, by loaning it out. So when the gap is really good, they can borrow at a short term using, basically at a short end of the rates, and then also lend it out at the long end, which means they make that's the margin that the banks usually make. And so the incentive for the banks to loan out money is great when the gap is great. And then when it inverts, which is what's happening here, where the 2 yield is greater than the 10-year right now, the margin is then as great for the banks, which means they have less desire to loan out money. And that's usually why the economy slows down, when the yield inverts. And then basically what happens here from here onwards is that usually in a normal business cycle, the delinquencies rate go up, because what happens is you're loaning out. So let's take 2008, for example. All this period here, loaning out, massive gap between the two, I guess, the different maturity of the yields. And then basically the banks are making all this money, loaning it out into new loan into the system. And so it creates a huge influx of new loans in the system. And so it inflates the asset prices. But when they slow down the lending activity, basically the growth of the loan slows down, which means the growth of the asset price increases slow down, which means you know, the borrowers can no longer rely on asset price appreciation to kind of pay off their loans or whatever it is. So what I mean by that is when the asset prices are rising and when the economy is good, it's all good, right? So you get paid, you can make your mortgage repayments and so on. But then when the asset price starts depreciating or it starts flattening down and you start having unemployment, or that's when the loan growth really slows down, which in turn leads to, depending on the rate of loan growth here, it can lead to massive depreciation of asset prices, like the housing prices. And you will see that you will see this through delinquency rates. So if I go, so if you look at the delinquency rate here, and if you see a pickup from say 2006, and if you marry that up to this chart, it's when it started inverting here, that's when it really started picking up. And so what happens as a result of that is, and so this is what we need to watch out for. So ultimately, I don't really know whether I can't really answer your question, Andy, because I don't know if this business cycle is necessarily different, because I think we just need to wait and see what happens from here onwards. But I think it could be different, because what you'll see is, this is a chart of Dow Jones. So 2006, when the delinquencies were picking up, the Dow Jones still continue to rise in its prices. But what you will see is, this is the point at which banks start seeing the delinquencies rates pick up. So as you can see, 2006, this is the point. And what do the banks do? You see the banks start to buy up bonds, which is why the yields start flattening out. So if you can see, both the 2-year and the 10-year, they start flattening out, which means, you know, and obviously the bond prices are inverse of the yield rate. So basically the bond price is coming down. Okay, let me just put on TLT here. Are you following me, Andy?
Yeah. So what's happening is you get the delinquency rates to kick up, which is it's a precursor to deflation in the system, or disinflation. I'll start disinflation, potentially deflation, depending on how many loans go bust in the system.
Mm-hmm.
And then what is happening is the banks are positioning and buying bonds, which suppresses the yields, and bond prices go up. So they're repositioning for the potential deflation that is coming.
Mm-hmm. That's right. So this is the delinquency rate picking up. So, okay, so let me just clarify what this chart is telling you. So this is the yield at the top. This is Dow Jones. This is bond, TLT. And this is delinquency rate right at the bottom, right? So basically you see the delinquency rate starting to pick up. You can see that the banks are starting to buy up bonds here. TLT is starting to go up. So the bond prices are starting to go up. It flattens out. And then as the delinquency rate is really picking up, what you see here is TLT actually breaking out. So this is an important point here. TLT is breaking out, which means banks, as the delinquency rate is, and this is uninverting, basically.
Yeah, that's when it uninverts. So, correct. Yep.
Uninverts. And then you've got Dow Jones still flattening out, and then you've got a bunch of money. This is the breakout point for your bond prices. So it's actually starting to go up, and this is delinquency starting to go up. So what you'll see here is these two charts marrying up. So delinquencies pick up. Basically, I'll describe to you the chain of events. So basically what happens is your loan growth rate slows down here because banks aren't yielding enough. And then you've got the delinquency rate that's starting to go up. And then you've got banks starting to the smart money starting to pile into TLT. And then eventually it leads to a crash in the asset prices. This is what usually happens in a business cycle. And this is what we need to watch out for, the delinquency rate, because this is really what causes the deflationary pressure to asset prices. Without this, I don't know how we see a huge downward pressure in asset prices. Let's say, for example, real estate. And so right now, what you see is, let's just compare that period to here. So right now, we're in a declining, right? So here's a couple of things that we can highlight. So we've got yield that's going up here, right? And then we've got delinquency rate going down up until around this point. Delinquency rate that's going down still. So I would say we could be, just looking at those two measures, we could be around here. And so what does that mean for ESA prices? That means we might still have quite a long way to go. And this is and look, I'm not going to try and guess where Dow Jones is going to go. So the valuations, if you compare to here, is pretty stretched for the Dow Jones Industrial Average, for example. But if I just change this to used oil, for example, oil price, we still had quite a bit of way to go in oil price here. So we don't know where this yield is going to stop as well. So we could be well before it starts flattening out. But yeah, I mean, we need to see the delinquency rate. To answer in short, to give you a short answer, we need to see the delinquency rate start picking up before I get worried about a massive deflationary pressure.
Yeah, so I think that spells it out pretty well. But I mean, so we have to go flat first, and then we have to uninvert, which could take a year or two even, right? I mean, that's when we did that that was in 06, and we didn't crash till 08, which was about a year and a half, 2 years or something like that.
Yes, you're exactly right there. So if you want to see what the futures market is pricing in right now, you just have to go to CME Fed Watch tool. And then you're right. According to this, we're not going to start. So basically, if you look at June, we're still going to be raising into June, I think, is what this is telling us. Or we're going to start flattening from May to June. So basically, if you want to draw that out, you're going to start flattening around May next year, around middle of next year. So around this point is when you start flattening out like this, potentially. And then we still probably have another ways to go until we flatten even more. So if you look at November, we're still sitting at the highest probability for 4.5 to 4.75%. So if we were to just plot that out, we go to November. And so this is where we could still continue to flatten. And then December is when the futures market is actually saying, maybe we'll start cutting then, right? So that's when we start cutting. But then also, when you do start cutting, you still have quite a long way to go. So, okay, so this is when you really started cutting. Let's say this was the peak here, peak around this area. The time it took was 742 days. That's nearly 2 years, right? So from the time the interest rates peaked to the time when there was a market crash or crash in the oil prices, that was 2 years. So basically, if you want to draw that out, and let's just say it follows exactly what happened here, and using the futures market, we're gonna start flattening here. Let's say from this point, so let's say we hit the peak right here, 4.75% or something like that, 4.75%, and then we draw this out and go, okay, it's gonna follow 742 days, and it doesn't necessarily have to follow 472 days, but 742 days, but let's say 740 days here. That takes us to December 2025, right? Of when, if we were to repeat this pattern in the time frames, it's not until December 2025 until we expect a massive crash, deflationary pressure everywhere else. But also, that also means we need to see the delinquency rates pick up, start to pick up soon as well, like that. And so these things, for me, these things have to line up before I make a decision to kind of get out of commodities or get out of everything pretty much and jump into bonds, because that's where you want to be, right? So at this point is where you want to jump into bonds temporarily. If you can see this is the point where oil prices go down, plummet, and then bond prices, skyrocket. And so, I'll need to see the multiple things play out before I get out.
So here's another question then. Do you think this, every time we see this cycle, we go from So we just stopped talking about the 2 and 10-year yield, how it inverts, how we get like a 1.5 to 2 year gap. I should say a 1.5 to 2 year lag for the yield curve to work its way up, go basically flat, and then work its way back down to uninvert. And really the driver there to watch for is delinquency rates, right? Because the delinquency rates is what puts pressure on the system for a deflationary type of environment. Now, we've got all these people talking about, and I see these people, a lot of YouTube people, a lot of analysts, lots of economists. They're all talking about this crash, and it's like going to be so soon. Do you think they're right? Do you think there's any validity to it? Or do you think like they're just too early? Like, because I hear it all the time, and I'm like, where are the delinquency rates? Where are the foreclosures? Where's the inventory of real estate? Where is the hyper supply phase? Are we just going to skip the whole hyper supply phase of real estate and jump straight to a crash? I mean, that's where I get confused, because we're not following the business cycle anymore. We're following a stimulus cycle, so to speak. So
yes.
what?
And so my question is like, where will the crash come from? Because if you look at the real estate cycle, it's usually a 20-year cycle. So, you know, we might have like a mini hump here, like a mini slowdown. But then, I mean, it's very hard for me to imagine like a full-on crash in the housing market in the US anyway. Because I mean, just by the nature of it, I mean, if you think about it, we've cleansed out the entire mortgage portfolio back in 2008. I mean, our books are nothing like the bank's books are nothing like the books of 2008. And so you can see that through the very low delinquency. So this is the delinquency rate. You can see the very low delinquency rate right now. So, I mean, if you look at the trend change of the delinquency rates in that really happened in 2005. So it was slowed down, and then it started flattening out, and then delinquency rate really picked up in 2006. And the crash wasn't until 2008. So, you know, it was a 2-year period. Once again here, I mean, we've had this delinquency rate come down here. And this was really driven by the NASDAQ bubble, right? So if you look at the business loans here, let me just try and pull it up. Delinquency. The business loans really started, I think, commercial and industrial loans, maybe this one. Yeah, so this is the 2000 crash, right? So it was primarily in the stock market, right? So if you think about it, it was the NASDAQ bubble. It was, you know, very heavily tech-focused companies that started going bankrupt, which led to the 2000s crash. And you can see that here, like it picks up dramatically. So when did this pick up? So, you know, if I draw a time frame here, for example, that was the bottom. And then it really, you started really noticing the trend here. But that was 1999. And the crash didn't happen until 2000. So you still have about a year of warning. And then from the bottom here, 1997. So you had a 3-year warning. Right now we're flattening out here. So at some stage, we're probably going to see this, you know, start to rise, but we're just nowhere near that. So in 2008, for example, it bottomed in 2006. And the crash didn't happen until a lot later. And once again, this was a different cycle because now we're talking about housing loan crash. But I'm just trying to think, where is the crash coming from? So I don't think it's going to be in the housing market because the loan's clear. The mortgage market is, you know, it looks very different, right? If you look at even if you look at the bank's balance sheets, for example, they are so much more liquid, so much solvent. Their capital adequacy, for example, is much better than back in 2008. So I don't think it's going to come from there. Where is it coming from? Like that would be my question. Is it coming from the tech sector again, which is possible? But then if you look at this delinquency rate, once again, for commercial and industrial loans, we're not really seeing signs yet. We could, I mean, yes, I'm not saying that we're not going to see at some stage this come back up, because obviously it's a rounding bottom, right? It's in the process of forming a round bottom, but I think it would be very premature to try and predict when it's going to start lifting up, if that makes sense. So I'm not going to try and predict. I'm just going to be observing all these measures. I think delinquency rates are probably the best indicators of a recession for me, because I know everyone talks about yield curve as it being like the one as it being the be or end all thing, But if you go back to the 1970s, for example, I mean, and this is a period where we had very high inflation. Like it just did weeks up and down, up and down. It was very unpredictable. So, you know, you could have said, oh, crash is coming here. But then that was 1978. And if we just go back to the SPX chart, all right, let me just go back to SPX here.
19 run out of chart.
All right, so let's just put this on log.
Mhm.
And auto 1978. So that there wasn't even a crash here. So that's the thing. So yield curve inverts 19. Let me just see if I can put this on here. Actually. Okay, let me put this on the same chart so it's easier to see. New pane. So yield curve, if you want to see where it inverts, I'll just put it on 0 mark here, around here. So yield curve inverted this point here, right? This is when the yield curve inverted, and everyone would have gone, oh, crash, yield inverts. Look at what happened to SPX. So S&P, like there was no crash. So yes, I mean, and I think that's why it's so important to understand why, right? So as we explained earlier in the video, the yield curve usually leads to a crash because banks are less likely to loan out because of the thin margins that the yield inversion creates, right? So it causes slowdown in the loans, in the growth of the loans, which in turn, in a situation where the economy is very highly leveraged, which in turn creates deflation, slowdown in the asset price, growth of the asset prices, which in turn leads to, which is in turn means it's very sensitive to, or very much exposed to any decline in prices because it leads to delinquency rates, right? And it leads to everything coming crashing down. Whereas in this case, like there is no, from what I can see anyway, I can't really see which part of the economy will be subject to anything like that, like we've seen back in 2008.
Well, do you think the car loans could, because we've had a lot of really bad car loans, is that a big enough market to really disturb anything though?
Is it? I don't know.
Yeah, car loans is where I think the
Let's see how big it is.
Yeah.
523 billion. I mean,
it's not big enough.
I just don't think it is. I just don't think it is.
Mortgage, I mean, I'm reaching here. I'm reaching because everyone's saying we're going to have this huge, like, massive crash. And
yes.
Now here's a question. Can the yield curve invert? We actually get massive inflation and stocks pull back because of the inflation, because of the increasing interest rates, and the stock market is just more or less pricing in net present value calculations with higher interest rates.
100%. And that's exactly what happened back in the 1970s here. So all this zone here where it just grinded sideways, that's from, and for me, I think it's two things. So if you actually go back to the 1970s, surprisingly, if you look at most of the companies, their revenue and earnings still grew, right? That's one thing that we need to note, because with inflation, the earnings grew, but stocks didn't do anything. What it really meant was, I think there was a risk premium being placed because people were uncertain about inflation and how that was going to affect the companies. They just discounted at a much greater risk. So they, that was the risk premium basically that the stock markets was looking for. But if you look at the earnings around this period for most of the companies, their earnings grew with rate of at a rate faster than the rate of inflation, which is really surprising. But yes, it could go sideways because it's the risk premium that the market's demanding, right? Because of the uncertainty, because people aren't sure, how it's going to play out. They just demand a higher premium for the risk that they take. But basically what happened was, this was probably the period where it was best time to buy shares, because I think a lot of the stocks, when they first started off, they were trading at 10 to 20, your classic range of PE ratios. And then towards the back end of the 1970s, I think they all started trading at single digit price to earnings ratio. Not because the companies didn't grow, but once again, because of the risk premium that the market demanded. So yes, I think, could we see something like this? I think we can, because people are fearful right now. People are demanding, I guess, a higher level of premium for the risk that they take. And so, yes, I think so.
Yeah, and we have a ways to go, because we'll probably end this cycle and do another mid hump, and then you want to buy it off that bottom second hump is where I would buy stocks for a long-term hold if we've got enough commodities and energy to continue a cycle like we did. Yeah, so I mean, I keep getting stuck on the stimulus money coming into the system and how that has distorted the signals in the market. Do you think that stimulus money distorted the signals in the market, and this next cycle may play out differently than other cycles, or do you think it's just going to amplify whatever was in place already?
So yes, I think it's going to be different, because the reason why I say that is it's obviously slow down the rate of lending. Potentially it's going to, because of the less of the margin that the banks are going to make on their loans. Yes, it's probably going to slow down the rate of lending. But what's also happening is this checkable deposits and currency for the households are growing like crazy. So they will want to, at some stage, deploy that money.
How is it growing
I don't
like
know
that,
when.
though?
Because I think people just have way more money right now. That's all the stimulus money. And the biggest misconception about the savings rate and how that's been declining. And people talk about this a lot as another indicator that we're going to have a slowdown, but savings rate. But what's really important to note, and hold on, let me just take this to the trading view. Okay, so it looks like a huge plummet, right? So if you look at this, it looks like a huge plummet, but you've got to note that this is on log chart. So this is where you're going to, yes, savings rate is low. Historically, it is low. But what you need to also note is 2.3, it's sitting around 2.3% right now. That's still positive savings rate. And obviously that's going to go into building up further your savings in your bank accounts, right? So it's not like they are they're in the negative territory, and it's not they are doing it because they can't pay off the loans, as you can see here. I mean, for me, the way that I interpret it, I might be wrong, but the way that I interpret it is, let's say I had pre-COVID, let's say, okay, so 7,700. So let's just say I had $770,000 in my bank account pre-COVID. It's just a random number, right? Just to make the math easy, just following this. And, you know, I didn't have the propensity to spend because I was like, oh, I need to buy a house with that, or I need to buy a car with that. Let's save up for a bigger house, or whatever it might be. And suddenly I have $4.9 million because of all the stimulus money. And obviously this is being exaggerated. Maybe the better way to go about this is by saying, okay, I had $7,000. Now I have, you know, $50,000 in my bank account. Well, obviously for me, I feel like I don't need to save as much. Do you know what I mean? Right. So the fact, so you know, for a while, it can drive the economy further, because now people are saying, okay, well, I had 77,000. Now I've got 50 grand. I feel like I can go out, buy new TV. I can splurge on myself a little bit more. I can dine out more. And I don't know about America, but like if you look at where I live, there's no sign of slowing down in terms of restaurants, and or if you look at roads, for example, even like, I mean, it's as busy as it was pre-COVID, you know? So, you know, restaurants are always packed. It's hard to get bookings for restaurants. And I just don't see any signs of slowing down. And I think that this is exactly what's happening. People feel like they've got more money and they don't need to save as much, because they have all you know, obviously built up quite a large sum of savings in their account, and they feel like they can go out and spend. And so, you know, I don't think you can just look at the savings rate alone and go, oh, people are saving less, the economy must be bad. I think you've got to put all these data sets together and actually, you know, deduce some kind of reasonable conclusion out of them.
So I'll just pivot here to,
yes,
And what are all these economists and all these other guys on YouTube that are saying that this gigantic recession's coming? What data are they looking at? Like, how are we getting it different than them? Like
I
what?
think they are looking at, they're focusing on little set of data that looks bearish. So if I just picked our savings rate and if I didn't have a view of anything else, obviously I would be like, oh, this is bearish, right? But if you put it together with other sets of data like delinquency rates, can people actually pay back their loans? Yes, they can. I mean, it's like, and it's historical lows right now. It hasn't even started rising yet. So yes, they can, right? If you look at the amount of household checkable deposits and currency, they've never had this much money ever in the history, and it's still on the rise. So can they afford to? Do you think they can afford to pay back their loans in the short to medium term? Certainly, this data says yes, certainly likely. Their savings rate might be dwindling. Yes, that looks bearish to me, but you've got to put all these things together, and you've got to really ask the question: is the saving? I mean, you can say savings rate is down to 2.3%, which is as low as we saw back in 2005, but we didn't have a crash until 2008. So what? I mean, just looking at this data set, like, why would you? If you were smart, if you were intelligent about trying to get some type of information out of data, why would you just look at this data and go, oh, we're going to definitely go into a crash in the next 6 months, if historically it didn't tell us that? So I think you just need to put all these data sets together.
The way that I look at that data, the personal savings rate tells you absolutely nothing when looking at the recessions, because there's a bunch of recession, there's a bunch of like downward movements and then higher all over the place. It doesn't indicate anything. So why would you even use this as a data set?
Yes, I agree. And if I just look at this, actually, so if you look at the general trend, it's going down. It's going down for a long time. They all go on a massive downtrend for a long time, and then actually during recession, it's when savings rate picks up.
Yep.
That's a funny thing to note as well. So
as long as it's going down, you're good. Is the way that I read it.
Yes. As long as it's on a downtrend, it's probably good.
Yeah.
People are feeling confident.
Yes.
I don't know, but you just need to look at all these other data sets. You can't just look at one thing. And I think on YouTube, on other YouTube channels and things like that, I think that's what they're very much limited by, because they just look at one set of data and go, oh, that's negative and that's why we're going to have a crash. But no, if you put everything together, actually, there's no real fear.
Yeah. So, but these are like big time economists, though. They're like this supposedly big name, economists like David Rosen, whatever his last name is, and all these other guys. And I'm sitting here thinking like, I've read some of these guys' papers from, what's his name? From Princeton and Schiller and some of these other guys. Like you read through their stuff, and I'm like, I don't, the stuff that they've kind of produced, I was like, I don't know if this is, I mean, I'd love to see him in engineering. I don't think he'd pass. Like, I'm like reading this, I'm like, you're going to use sentiment as your leading indicator. You're going to use this for that. You're going to use sale. I mean, I'm just like blown away. I'm like, none of this is like hardcore data that you can really wrap your mind around. It's all off of like emotions and feelings and all that, which I understand to some degree, but I don't know. I mean, I was just reading it and I was kind of dumbfounded at how if we were to do that in engineering, you'd get kicked out. If you did this in the business side, it's like, oh, it's all good. Like, this makes sense. And I'm like, no, it doesn't. Like, so I was looking at that. I'm trying to make, use of all this data that we have at our fingertips and all these charts and everything. I don't see the deflationary pressure yet. I don't see it, but everyone's calling for a crash in 2023. What am I missing? Like, that's what I keep trying to find. I'm like, what am I missing here? Am I missing anything, or am I not missing anything? And I think that they're necessarily wrong, because here's the difficult part. This is why it matters so much, everybody. This is everything here.
Yes.
The uranium sector, the oil and gas sector, the commodities sector, they rally when these conditions are present. This is when they go. They are a late business cycle stage runner. And they run all the way up until they run out of steam, and we see the delinquencies, we see the real estate market go into a hyper supply phase, and then we start to decline. And they have a blow off top right at that end. And the reason it's so important is I'm listening to people tell us that this, like, basically the business cycle's done. Oh, we're going to see a crash in 2023, probably the first quarter. And I'm like, where's the delinquencies? Where are the foreclosures? Where's anything? Because if that doesn't exist, you can't have, in my opinion, a 2008 crash. The 1929 crash was a real estate market collapse and a deleveraging of the banking system from the mid 1920s, like mid to late 1920s. And that happened in 1929 and onward. I don't see any of that though. I'm looking for it. In 1970s, we had a crash in the middle of the 1970s into a recession. The inventory levels were from 10 to 12 months of inventory levels in housing, and the housing starts collapsed. The loaning collapsed. It also happened in 1980, early 1980s. I'm looking at this like, it's not like the 1920s. It's not like the 70s. It's not like 1980. It's not like 2008. Where are they getting their data from? And I'm getting super, I'm getting annoyed. I'm like, where is your data, guys? Like, you have no data. You're just talking out the bunghole, saying, this is what's going to crash. This is how it's going to happen. I'm like, I want to see the data. And none of these guys, they'll say sales prices are going down. Sales prices doesn't drive credit growth. It's the volume of loans. And if they don't understand that, now they could say the volume of sales precedes the volume of loaning. But when I look at total bank credit, it's going up. So I'm like, I still, I'm uneasy because there's no signs of where that deflation or deleveraging can come from. And if there's no signs and there is no data or anything to have the deleveraging, why would you have a deleveraging? I'm getting like frustrated because I'm like the sole person against everyone else, which may be a good thing. I mean, if you notice, everyone is bearish on YouTube. Everyone. I don't see a single bull out there. I don't know. Do you see that too, Scott? There's like no bulls on Twitter.
Everyone's expecting a crash. Everyone's expecting a crash next year.
Everyone.
Yes, I find the same. Like it's like everyone's talking about a crash, but I'm just like, what are we looking at? I mean, I was quite bearish before the March 2020 crash. And it's because I was looking at delinquency rates, I was looking at yield curve and things like that as well, but I was putting everything together. But I mean, right now, like, I'm just like, there's I don't know why. Like, I mean, we've got such a, I mean, it's really simple. Like, I mean, the way that I think about it is really simple, right? So let's say I've got savings rate like this, like how, and just imagine it for yourself. Let's say you've got,
a multi-millionaire.
Unprecedented amount of savings in your account. And I mean, how long would it take? Like, even if you lost your job, you could probably survive through for a good couple of months to a year or whatever. But
what about the data that they use? So let's use their data. All right. So they're saying the home prices and the sales are going down in the real estate market. And some of the real estate markets are overheated, like Austin and some of these other ones. Yeah, I get it. They overbuilt for the interest rates that we have today. But the interest rates today are there because of stimulus money that they created in 2020. But if you look at the total bank credit, the total bank credit continues to go higher. We're like ratcheting higher. So we're not seeing any destruction of loans yet in the system for total bank credit. It's not there. The delinquencies are not there. The foreclosures are not there. And that usually takes a good year or greater for that to kind of come into the system. So, and we have to have people underwater on their loans that put like no money down. So I think there's very few of those people anyway. So this is going to take probably a year or two or something.
Yes, and with the total bank loans, I mean, it's on a growth trajectory, and The only time when you need to worry about the loans in the system is when the delinquency rate offsets the growth rate, and then takes the total amount of loans in the system to a negative territory. That's when the disinflation or deflation happens. And so when you're not seeing the loan growth offset by the delinquencies, it means you are increasing money supply within the system through your loans. So
Well,
and that's eventually going to lead to higher. Yes.
If you look at your M2 money supply, though, M2SL in trading view, that is going sideways to lower. But you can also see that the bank's balance sheet is what's declining.
Yes.
So the bank's balance sheet is basically they're offloading their, you know, mortgage-backed securities and all that other garbage they have on their books. But if you look at the velocity of the money, it's going up. So the money in the system is staying in the system. And I think that's coming from the deleveraging of the Federal Reserve's balance sheet. Because if you look at the Federal Reserve's balance sheet, it is doing the same thing. It's rolling over just like that the M2 money supply. But your velocity of money is kicking up, which means there's a bunch of money that they hold, which is probably part of the M2 money supply, that is not counted in circulation. So it's a very very interesting dynamic. Yeah, there's velocity of M2. See it kicking up?
Yes, and imagine, and this is basically, I mean, you can put all this data together. So another thing that I can kind of tell from this is basically you've got this, what is it? So you've got all this new money that's been created in the system. So you've seen the household checkable deposits skyrocket, and they're not really spending that down, which is why the M2 velocity of money is really staying down, because, you know, people haven't gone out and spent all their savings like crazy. So once they start spending it, and once this starts picking up, then you're going to see huge inflation everywhere. And on top of that, you've got SPR release that's coming to an end. And I think we've just got, so for me, I try and think opposite to what everyone else is thinking. And so when everyone's talking about, you know, let's say for example, iron ore is a pretty good example, right? So everyone was really bearish iron ore because everyone's going to, you know, China's going into a lockdown, you know, they're probably not going to build or whatever. But I'm like, this is when the sentiment is at its lowest, and the forecast for iron ore consumption at its lowest. You need to think the other way. You need to flip the other way and go, actually, this is the lowest. The only way that it can actually go from this point onwards probably is that the China demand picks up because they reopen again, because obviously they inevitably they will have to reopen unless they want to, you know, shut themselves down for forever and ever. That's just not going to happen. And so you think the other way and go, okay, China's probably going to reopen at some stage. When everyone's bearish, you need to think the opposite, right?
So have you looked at the housing market sentiment and home builders sentiment right now? It's like the lowest it's ever been. So is this,
No,
I mean, I'm just thinking opposite. I'm holding a ball here. If you, I know I've got a little volleyball that I've been like squeezing or whatever. But like, is this would that indicate that now is actually a good time to buy a house because the sentiment and home builder sentiment and all this other stuff, they're like everybody is just negative, and now is probably the best opportunity because everyone's so negative. But I think the demographics still intact, and it's probably going to come up to a good buying opportunity window at some point here. It's at some point in the future here.
But I'm not sure about the homes. Yes, but I think generally, like, I mean, well, you just need to zig when everyone else is zagging, and zag when everyone else is zigging. And this is a book from Philip Fisher. He basically said, zig when everyone's zagging, zag when everyone's zigging, right? You just need to, and it doesn't work all the time, because obviously there are genuine reasons why, you know, everyone's bearish. Let's say, for example, you know, coming off horses and moving into cars, for example. I mean, horses are probably never going to recover because the technology advancement is that great. But when we're talking about things like iron ore demand, or base metal demand, or, you know, gold and silver demand in an environment where, you know, money supplies has increased exponentially, then I think it's probably relatively safe to say, you know, you need to zig when everyone's zagging and zag when everyone's zigging. And I feel like it's like that with a lot of the things right now.
Yeah, a lot of different things.
Yeah, because I mean, and the thing that I would challenge everyone on is show me the data. Like if you can show me one, if you could show me a set of data that supports your argument, fine, I'll listen to you. But when you're just doing it purely based on sentiment, if you think about the sentiment of investors, even on Twitter, for example, like oftentimes we are wrong, right? As a community of retail investors, or even like expert investors, right? In the investment industry, like most of the times they're wrong. It's only very few that get it right. Like the billionaires out in the world, you know. So yes, I mean, try and think of an argument against what everyone else is thinking. I think that's key.
What about, I know a lot of this is cited a lot, that regular people are racking up credit card debt. Is that a legitimate argument for that they can't afford what's going on today?
No, because
I know I'm spending more because of
I'm
food and
spending. I
everything
mean,
else, but I pay
okay,
it all
so
up.
yeah, I mean, if you think about it, right? During COVID, my credit card bills like half. I was spending like 1/3 what I normally spent on my credit cards because there's nothing to spend it on. Like, what would I do during COVID when I'm in a lockdown, right? I wasn't spending any money. And then you come out of COVID and you go, wow, like life is great again. And you can go out to restaurants, you can go out shopping, you can do whatever. So obviously you're going to be racking up your credit card. So my credit card bills now is like 3 times higher than what it was during COVID. So I think it's just natural. And, you know, during that time, you might have, you know, lost a couple of credit cards. They might have expired and then you create new credit cards, you know? So I don't
I
think
wonder how they calculate like the savings rate. How do they calculate that? I mean, is that just like what you're putting in your bank account, or is it like what you're putting in your like stock market investments and stuff? Because I don't keep much money in my bank account because I know that we've got inflation. So I'm like moving my money out of my bank as fast as possible and putting it in, like physical precious metals and other things. And that would look like I'm poor, but I'm like becoming wealthier as time progresses, at least for my case. I'm not saying in every case, but I wonder how they actually calculate that, because maybe it's a misleading calculation anyway.
It says hold on, it says it may generally be, I think the savings includes the funds to capital markets to invest in real assets such as residences, it says.
I don't know how they would
I don't know. Like, I mean, with this data, I mean, yeah, you don't know that. You don't know those things either. So
and then yeah, and do you think that money is like, I'll say, migrating in fewer and fewer hands, but it's just getting massive? And then
it could be.
the
Yes.
lower amounts of like the lower 20% or something, like they just have nothing. They're just really, really hurting. I mean, it's possible.
Yes, that could be the case. That could be the case. But I mean, if you're thinking about the delinquencies that can lead to deflationary pressure, you are talking about the top percent that owns multiple homes, for example, that are renting the homes out, for example, right? So, you know, yeah, I think the total amount of loans and total amount of delinquencies is what matters, not the inequality between within the economy, and between the different groups of demographics. So that's what I think.
It's a lot of we just covered a lot of stuff there in terms of recession, delinquencies, and all that other stuff. And I'm still in the camp that, I'm not saying that a recession can't happen. I just don't see where this blowout crash can happen. That's where I'm looking. And if we do have one, I don't think we're within 6 months of it. And that's where I get confused, because I see a lot of people calling for a crash like first, second quarter of 2023. And I'm like, man, that's like basically we're at the top right now, ready to crash, because we're going into 2023 in a couple of weeks here.
I know.
So
I know.
That's where I'm getting confused. So
yes, I'm getting, yeah. I mean, I don't know, Andy. I don't see it. I mean,
I
I
don't
don't really see it. I mean, if you think about even Nasdaq, I mean, obviously it's overstretched. I'm not going to try and predict what will happen to Nasdaq, but I mean, it's nothing like the dot-com bubble of 2000 if you look at the valuations, right? Because in 2000s, you've had like Yahoo trading for the entire market capitalization of New Zealand, all New Zealand stocks combined, and it wasn't really generating a lot of revenue or earnings. So, you know, and we've got like now in the Nasdaq, if you look at even the FANG list, you know, Facebook, you know, Meta, you've got Microsoft, Apple, and things like that. They're not trading at ridiculous valuations. They might be trading at 25, 30 times PE ratio or whatever, but that is, you know, typically somewhat normal valuations for a growth company. That's growing steadily at 20, 30 times 30% per year or something like that. So we're not, I mean, in terms of valuations, I don't think I don't know how Nasdaq can crash as much as it did back in 2000s, just because I don't think the valuation's that stretched. So I don't know, Andy. I don't see it.
It could
but
if we get interest rates to go way up.
it
If that
could.
were to go up more.
Yes. And that I mean, everyone's now thinking also interest rates are likely to come down, and obviously the futures market is pricing that. But how do we know that? Like, it might that might not be the case. I mean, let's say China comes out of lockdown, and we've got SPR release that's ending, and oil prices skyrocket, for example, and all the input costs start skyrocketing, like iron ore prices start skyrocketing, say for example, because China orders a bunch of iron ores or whatever to kickstart their economy, and all the commodity prices go up. Then, you know, we might have inflationary pressure again that they want to fight. They might want to fight, and we might see higher interest rates again. So all these things are really unpredictable right now. But the data that I'm looking at right now doesn't tell me to sell all my assets, if that makes sense. So until it does, I'm just gonna sit.
That's all I'm doing. Just sitting and
Yes.
relaxing, enjoying the ride. But that's all I've got, Scott. Do you have anything else you'd like to share? Or are you all good?
No, I'm all good. I'm all good. I just wanted to, I guess, thank you, Andy, because I know, like, I mean, commodity prices haven't done so well in the last 6 months or whatever, but then you were really strong during that time. You're still posting up videos every day. And I was almost thinking, like, you know, I don't know if you know the Bible so much, but Moses. So Moses in the Bible, basically, he takes all the Israelites, all the slaves who are Israelites, people of God, out of Egypt, and then all these people chase Israelites, and then he helped the slaves escape Egypt. But basically, people turn around when they're facing difficult times, like they can't feed themselves and they're hungry, or they're faced with danger. They blame Moses for helping them escape as the slaves, and so. And he must have taken a lot of courage during that time to go, no, we got this, you know, and still, you know, be very confident and act with a lot of conviction. But I feel like that's kind of what you're doing right now for the commodities community. So really,
Well,
really
the thing
appreciate all
is,
the
like, it's not me like trying to. I'm just staying the
Yes.
course because I don't see.
Yes.
How can I say it? I would change my mind immediately if I
Yes, me too.
see the housing market go to 10 to 12 months of inventory. We're at 2 right now. If we go to 10 to 12 and we see the housing starts dive, I'd be like, okay, something's coming. Like this is not good.
Me too.
But
Me too.
But we're sitting there at like no inventory. Housing starts are about average right now, just chilling, going average. And I'm like, there's nothing to worry about right now.
Yes.
Like
yes.
this is the time that we could go. Like this is the time that we could accelerate off and go to, you know, a Wonderland, we'll call it, or Cloud9 or whatever you want to call it, however you want to say it. And the market conditions are there. Like this is when they go. And everyone else is like, well, there's going to be a crash. I'll wait till after it. And I'm like, you guys, like, I don't know. I have, I guess, a bigger fear of missing that move. I mean, they call it FOMO. FOMO is when you chase something. I'm not chasing anything. I'm just waiting. Fear of missing out is when you go in because something is going up. Right now, we're going down. And I think that that's like the end of a first wave coming, which I think is a third wave that's about to come at some point. And everyone else thinks we're going in the opposite direction. That is when you get the squeeze, is when everybody's positioned wrongly. And that's when you squeeze it. If you notice, I think there's a record number of people shorting the stock market right now.
Yes.
Like it's off the charts level.
Yes.
I don't know if you saw that or not.
I did see that.
If it's a record number, do you think those people are right? I mean, they might be right for a short period of time, but like they are going to get squeezed if this goes the opposite direction on them. And we're going to go boom. Yeah. So I don't know. I mean, that's what I see. I've just been holding on because I still think the imbalances are in the market. And I think it's going to get worse in the next few years. And I don't see
and
the liquidity crash coming.
Yes, that's right. And I will definitely flip if I do see delinquencies start to pick up. You know, I mean, I'm not going to sell straight away because it takes usually about year and a half to 2 years for delinquency rates to actually hit the stock market or whatever. But if I do see it, then I will change my mind. I'll say, actually, maybe we don't have a lot of time left, but we're not seeing it. We're not seeing that. So I'm very much data dependent. I'm not really dependent on the sentiment or anything like that. I'm data dependent. So I'll just be observing my data sets and let them tell me what to do.
And previous markets, some of them, they kind of took off in like 04 and ended in 07. And that's a 3-year window. We could be right where we're at right now. We could be sitting on that 3-year window. And everyone else is like, it's going to crash.
Yes.
I don't know. I don't know about that. I'm going to sit where I'm at. And we've got these nice chart patterns too.
You have to, I mean, eventually the bears will be right. You know, maybe once in a decade. So if you look at Peter Schiff, for example, you know, he was calling for a crash from like even following the .com bubble. Like he was calling for a US housing crash from that point to 2008. And he eventually got it right in 8 years time or whatever. But, you know, you don't want to be that guy.
Yeah. And Harry Dent's been calling for like the largest stock market crash of all time every single year from like 2012 till now. Like this guy. And then the one year it happens, he's like, I'm right. I got it right. I'm like, no, you didn't. You called it every single year for like over a decade. And then I can't believe people still think he you know, they'll like refer to him. And I'm like, if you refer to Harry Dent, that like automatically, you know, says that what you're looking at is wrong. Because if you didn't look at the history of his calls, which is like he's got like a 0.1% success rate, 0.1. He gets like everything wrong, everything. And I think he has valid like arguments too on other things of what to look at, but he must look at it and just, I don't know how he interprets the data or what, but he's
and you know, we might not be necessarily right. So, but I mean, we've shown you the data that we look at. So what I would strongly encourage you to do is look at your data sets, look at the data sets yourselves, and then determine what you think is most likely. I mean, all we're doing is just putting a bunch of data together and you know, coming up with our interpretation of what that means. But you might interpret it completely differently, and that's up to you to determine, right?
Yep. It is. All right, Scott. Well, thanks for coming on. I really appreciate it. And
thank you.
We'll monitor this data every once in a while and see what happens. So
sounds good.
All right, guys. If you made it this far, you can put in the comment section. What should we put in the comment section? Be anything, Scott. What do you think?
Andy's a true leader.
There you go. Andy's the true leader. You know, Andy's a true leader. Put that in the comment section, and we'll catch you next time. This is Scott and Andy. See ya.
See ya.